Hello, welcome back to Duca's Copy TV. Now, we have Thomas Veillet in the studio once again. If you watched last week, Thomas was talking mainly about Facebook and Greece, but obviously we're hoping that Thomas is going to be a fairly regular guest on the programme to talk about news events and things that topically could be affecting the markets and the financial world. Thomas, just looking back at the Facebook IPO last week. What's the current situation? I know as an investing advisor at Capitalist and a blogger yourself, this must have been an interesting topic for you.
People were expecting to see an IPO like a great IPO, something would just come out in the market at 38 and maybe goes to 70 after that and say, okay, that's a great IPO. Mark Zuckerberg will be extra multi-billionaire, and it didn't happen finally, and that's a quite mixed sentiment because people are really disappointed about Facebook. There was a lot of expectation, positive expectation back on Friday morning, and suddenly the mood changed a lot.
Is that because of an excitement about Facebook initially, that it was sort of valued at initially valued at something like $104 billion, and now they're suddenly realizing, well, what actually is Facebook worth? What is it actually going to be doing in the future, aside from adding friends? Yeah,
that's really funny because we didn't question the valuation that much about Facebook before the IPO. But suddenly, as soon as the stock was on the market, really started trading and we started to see that it was not going that good. We started to understand that maybe there would be a problem of valuation, and we started to see that basically we are paying 65 earnings for 2013, and if you compare with Apple, for example, which is paid 10 times earnings for 2013, there is like a huge gap. They have to grow their advertisement business, and that's not that easy. They had last week General Motors just cancelled the contract they had with them for making advertisement on the Facebook site because they don't feel that it's that much rewarding. And we know on the statistically basis that 12% of the people who are on Facebook are clicking actually on the advertisement. The biggest question for Facebook, in order to keep that level of price around 33, 35, or whatever it is today, is they need to have some growth in the company, and if they cannot show any growth or a slowing growth, right now they have growth around 45 or 50%, something like that. I think if they cannot keep that kind of growth, it's going to be a blowout.
Okay, just moving very briefly on to the situation with JP Morgan. Just briefly, is there something psychological behind all this about long-term investment?
Everybody knows what's going on in the stock market. 15 years ago, in order to get the information, you had to wait the newspaper for the day after. Now you get everything online. So people are they have shortened their view on the market, and maybe they are buying a stock for a short time than they used to do before. And this kind is also accelerating the move in the market and the speculation and the number of people who want to make money quick and get out of the market. So that may be also something was adding some volatility in the market and some craziness on the market. When we saw what's happened next week, we got the worst week of the year in the S&P 500, and suddenly yesterday everything is booming like nothing happened before. But nothing has been solved. The problem of the Greece is still the same. The problem of JP Morgan is still the same. We don't even know what's the time of the loss.
So what about JP Morgan at the moment? Do you think that psychology is part of the situation with JP Morgan's loss?
No, I don't think it's a part of psychology. That's a big question. It's very tough to understand about all what we have seen in the trading business over the last few years, that this kind of huge bank and top shot bank is still able to let that kind of trader making that kind of bet. I might understand that sometimes you get the feeling of greed is good, and you say, okay, as long as I'm making money, I'm trying to get more money. That's, I would say, quite logical psychologically, but in terms of risk management, doesn't make any sense, especially after what we have seen on AIG back in 2009. Sounds like crazy, but they still did it. So either there is something behind this story that we don't get all the detail and we don't understand all the full story of the loss of JP Morgan, either it sounds like stupid. And Jamie Dimon said that's stupidity. It sounds like strange, but I think it's also a question of psychology of the market, because even if you got the Kerviel story a few years ago on SocGen, Société Générale, I think that we never we never learn anything about those kind of story, because every time you see an opportunity to make money again, you just jump in it and don't care about the consequences if there is some. But there is always consequence. There is no way to make money all the time. But it seems that banks and traders and everywhere in the world got the capacity, the ability to forget all this what happened on the past, basically. And every time you see an opportunity to make money, you go ahead and you try again. But you know that one day it's gonna come back. And maybe what's happened to JP Morgan. But it sounds crazy from my point of view.
Well, we'll have to keep a close eye on the see how it plays out actually with JP Morgan. Of course, thanks very much for another passionate analysis again, Thomas. That's all we've got time for on Dukas Copy TV. Stick with us though, we'll be back later with more interviews and updates, but until then, goodbye.